Welcome to Real Estate 360 with real estate expert Kenn Renner.
Tell me, sugar, what you don't understand. When life gives me lemons, I do what I can. Yeah, yeah. Hey, I'm addicted to it.
Who's that, Kenn Renner? Who's that singing that song?
Yes, hey, that's my daughter, Christine Renner. Yeah, I'm pretty proud of her. Yeah.
Nice. I like that song. It's got a little Joan Jett vibe to it.
That's exactly what she said when she wrote it. She just got done listening to Joan Jett's song. She wanted to do some a little bit more rocking than what she usually does.
I'm a huge Joan Jett fan.
Okay.
She's still cool, too.
She sure is. She's still out on tour.
Yeah, I know. She's still playing.
I was excited for her last weekend. She got to be part of the Moody Center opening. Moody Center, of course, as you know, is the replacement for the Irwin Center, a 15,000-seat state-of-the-art arena. And she got to play out in front of the stadium before the Bon Jovi concert.
Oh, nice.
So there's about 15,000 people that got to walk by her while she was playing these songs. And so we're going to, at the end of the show, we're going to go ahead and play that song in its entirety. And so I'm once again really proud of her. You check her out online. She's everywhere, YouTube, Spotify, all that kind of fun stuff. So
all right. Well, we're mixing in a little bit of local Austin music into the show, and but it's not a music show; it's a real estate show.
Absolutely.
That's why it's called Real Estate 360.
People asked her how she get that and that gig, and people are, you're pretty lucky. And it's kind of like my clients in real estate.
Yeah.
They say, "Are we lucky?" It's where preparedness meets opportunity. Yeah. She worked her butt off to get there, and then all of a sudden she gets there, and now it's and I was like, "Oh, you got lucky." No, she worked her butt off. Just like we do in real estate.
People don't see the work.
Absolutely.
Right? Yeah. Exactly.
Yeah. So I'm looking forward to the show. We've been off for a month. I was out in California earlier this month, just shaking hands and making friends and reconnecting with a lot of our folks.
Are you just meeting them at the border as they leave the state and just shaking their hand as they say goodbye?
Actually, we set up shop at the Hyatt House right across in Cupertino, right across from the Apple headquarters. Mm-hmm. So, strategically we were there. So
smart.
We're looking at, helping the investors, of course, and then relocation buyers right now. So we're a lot of focus of the relocation between 500 and 1.5 million in the Northwest Tech Corridor, which we're going to talk about, and then just regular investments. And a lot of things have happened and changed since, like we talked about 2 years ago, it's like they turned a switch on and the pandemic hit.
Right.
And about a month ago, it's been like they turned the switch off and there's no pandemic
over.
So, but still we have the fallout from that. We're going to talk a lot about that. It has a lot to do with the interest rates, inflation, rents rising, prices rising, and all that. We're going to get into that at the end of the second half of the show here. So, but I really want to go over the stats real quick and kind of prove our point of what's going on in the Austin market. We are not we're not slowing down right now. It could come, but right now Austin is still on fire.
Good.
So, and it will remain that way for a while. We just, stats show we just don't have enough. We have a half a month's supply of houses on the market.
Wow.
So that's 2 weeks.
That's better than it was, though, isn't it?
It got down to 0.1, which is basically a few days worth of supply. So, bottom line is there's still 150 people a day net moving here, and so the jobs are moving here. So let's just kind of take a little tour of some of the high tech jobs. And these are buildings. Most of these are still empty. The high tech workers haven't even got here, or they're working remotely, ready to get here. First one is the Google building. Beautiful building.
It is.
Drove by that. It's definitely a landmark downtown. Across from it's the Oracle campus. That's up and running, and it's they moved their headquarters there. So from Bay Area, about time to get out of Dodge there. So 10 miles north we have Amazon, Vrbo, Facebook, Indeed, all in the Domain, which is kind of the poster child for mixed use developments and kind of where everybody wants to be close to.
I remember when they built the Domain, I thought they were crazy.
Oh yeah, I mean it's right across from the old IBM building and the National Instruments are like, what are they doing there?
In the Pickle Research, it was just weird.
Yeah, and now it's the place to be, right? So every tech changes everything. So just about 5 miles north of that is beautiful Apple campus. It has not even opened up yet. So 6,000 highly paid software jobs is coming here, and that's really one of the things that's putting a huge pressure on the Northwest Tech Corridor. It's still multiple bidding. It's still multiple offers bidding at up to $80,000 to $100,000 over asking price for a medium price house and still not getting it. We're having to coach our clients into, see what we can do to find, cash or use one of the cash services that we have to be able to be more competitive in that market. So even with interest rates going up, even with prices going up, these guys have, coming from the Bay Area, have a whole lot different view of money. In other words, they've got their assets in stocks and bonds. They have huge incomes. In fact, some of my clients during the pandemic switched their jobs. A young lady who's a great client, she bought several houses from me. She started a startup, and then she went to Amazon, got almost double her income there, and then she went to Google now, and now she's almost tripled her income. So, yeah, so there's no lack of resources for the people coming in from the Bay Area. Now, for us locals, that's tough because we're competing against that. But that's just the reality, and they're all competing against each other. Up in our submarket further north, about an hour north of Austin, Meta, of course, Facebook's company, they are building a $800 million data center in Temple, Texas.
Wow.
So that's an area where we've sold hundreds of houses. It's a little sleeper market, and right now it's on fire. Still can get a really nice house for under $300,000. We're writing offer on a 2,000 square foot house today for $283,000. So an hour north, half price. Why do you,
right, might be worth the ride.
Why do you think Meta's there? And there's other data centers that are going in there too. Now, data center doesn't have a lot of employees when it's up and running, but the bottom line is put this area on the map. I mean, that's nearly $1 billion, and Meta's, those guys aren't dumb, so they did their research. And talk about one of the smartest person in the world, Elon. Elon's facility just opened up 2 weeks ago. The Tesla facility getting international news, and why not buy Twitter after opening a facility like that?
Why not?
Why not?
The funny one was that he was going to buy Coke and put the cocaine back in.
Oh, yeah.
He tweeted that.
Or he's going to buy Colleen for $83 and it was going to be a good deal, right?
right.
But that facilities, that's in the east side, but they're also moved their headquarters here. So, and who knows, would they ever move Twitter headquarters here?
There's people that are offering 100 acres for free.
I'll offer him 100 acres for free if I had it. So. But then the big giant news is the up in Taylor, east of Austin, northeast of Austin, still 30, 40 minutes from downtown off the highway. It's the Samsung facility, $17 billion facility. So all those facilities I just showed you combined is less than the value of the Samsung facility at $16 billion. And 2,000 employees, and I'm sure, and there are a lot of their executives. So that's going to be continuing to put pressure on the market for increased prices. And that's fortunate or unfortunate, whichever way you want to look at it. We're going to get into some of the ramifications of that, property taxes and things like that. I do want to go back to my famous chart, and you can study this chart when you get it. Just put it on pause if you're watching the video. But this is a really good chart. This chart has made my clients millions of dollars by following the trends of the market. And it's called the counter cycle to the coast. And if you go to the next property, this is a property that I own. And you can kind of see where my chart is. We had, it's pretty much a good 6, 7, 10% appreciation from the recession of 2008, 2009. Pretty nice clip. And then all of a sudden in 2019, 2020, we had a spike of almost double the value in just a year and a half. Now, if you look at the Bay Area, this is a house actually that I grew up where I was born at in San Mateo. You can see that in the 2018 time, there was a big drop off in the Bay Area while we were just doing this. So even in the last couple of years, we've still seen the counter cycle. Right now, though, you can see it popped back up. And so so it's back up to where it was. So this house at 2018 was worth about $2 million. 3-bedroom, 1 bath, by the way. And then now it's back up to about $2 million, but it dropped $400,000 and stayed down for 3 years.
Oh, wow.
Just think if you're trying to sell, then you would have lost $400,000.
Right.
All right. So that being said, we're going to get into some macro and microeconomics. I know we've been talking, and we try to, from the very beginning, even during the pandemic, this has been an optimistic show.
Yeah, it has. It's been a silver lining show.
Yeah, a silver lining show. And so we're always talking about the pros and cons of things that are hitting the market that will affect us to our personal pocketbook, our housing, our rentals, and our cost of borrowing, which is kind of everything that we do is depend from cars to credit cards and everything. So with the trillions of dollars that the feds pumped into the economy during the pandemic, and with all the jobs that are coming back on the market, and with this supply chain shortage, we're having an incredible amount of inflation, highest ever in the last 40 years. Okay. And part of the problem with inflation, I had to kind of study it because who cares if inflation goes up? Big deal. Well, it's really important when you have assets that are like cash, because it's dropped right now. I couldn't believe I thought it was 7. It's actually 8.5% inflation right now. And you can see on that chart. And look at it gone from April of 2021 to 4.2. It's doubled. Yeah. What does that mean? That means the value of your money is dropping at your buying power is dropping by 8.5% every year. So that means if you have $100,000 in cash, that means next year at this time, if it stays at that rate, it's worth $8,500 less, or like whatever that is, $92,500. Mm-hmm. Okay, so that means the value of your money is dropping, what the buying power of it. So we have to look for hedges against inflation, and real estate is probably one of the best hedges against inflation. So with the value, if you had $1 million cash, you're losing $85,000 this year in value. Mm-hmm. So what we're doing is we're helping people position their assets, reposition their assets into real estate and even private money. Brother-in-law owns a private money company, which offering somewhere beyond that inflation rate. At least you're getting enough to stay at least equal against inflation. That's a big deal. But here's the problem with inflationary periods, or when the feds take a look at this and they do what they're doing right now, which is putting a hard stop on the economy. They're hitting the brakes. That can be a problem, and no one's really even addressed the fact. But after you study, and one of the things that we talked about in this show for a long time, study the cycle, study history. What has happened in the past could repeat again. Doesn't always happen exactly the same way, the same time. I mean, who knew there was going to be a pandemic? But I'm going to spend some time on this one, because this is the interest rates going back 30 years. And I'm not going to blow the whistle on the big R word, recession. But people come to me because because I've been doing it for almost 40 years. I've been pretty good at predicting markets. I've been in 4 different states in 4 different decades, 4 different booms and busts, probably more than that. And so I've seen it coming. And I'm not saying that we're heading into recession. I'm also saying that if we were to head into recession, Austin would be one of the most insulated from a recession as far as that's concerned. But I want to show you this, because going back to my early childhood in 1975, remember the oil crisis?
Sure,
right?
people waiting in line.
Wow, oil crisis. We're hearing something about that, again. Now we're one of the biggest producers of oil because of the oil shale a couple of years ago, but it kind of put the kibosh on that because oil was cheap. Well, now it's coming back. So the point is on this graph that I'm showing you is that after an inflationary period almost always leads to a recessionary period. And historical. And those gray bars going back through history, those are where we had the recession. So you had one in 75, and you can see the interest rates popped up, and then the feds put the brake on the economy to slow that down. Same thing in 1980. That was just and then between 80 and 85, that's when I got in the real estate business. When I got in the business, adjustable rate mortgages were 11.5%. And fixed rates were dropping from 18 to 15%. And you can see that chart. And you know what it did when they drove the interest rates up to 15%? It put, hope that doesn't happen, but it put a real hard stop on the economy. And it took a long time to recover from that. And so what happened over the years between the early 80s and 1990, you saw a dropping of the rates going further down. Then early 1990, we had a recession. I was in Southern California at the time. I saw it coming, and I asked my father-in-law, my rich dad, I said, where would you invest? I finally got some money after this boom time. I'd like to invest somewhere, but it's not going to be in California because prices are probably going to go down. Hence, going back to that predicting of the markets. And he goes, you guys check this place out called Austin, Texas. 3 years later, I'm moving myself and my new bride here. Because I fell in love with it. I bought houses here. I'm a musician. I'm like, what's wrong with this place? Nothing, So see Willie Nelson down on 6th Street. I mean, it was like It was the day. You were here.
I was around.
You're on KLBJ, weren't you? When did you start?
No, I was never at KLBJ. I was here in '87 and started on the radio in '96.
Okay, all right. So I didn't mean to mention names.
No.
So in '90 we had a small recession, and that's actually was right after the .com. Yeah, when the whole stock market kind of crashed. And then we pretty much had a pretty good run up, and it didn't have another interest rate jump until about 2000. Oh, sorry, 90. No, I'm sorry, 90 was before before I moved here That was the first. That was kind of the aerospace recession. In 2000, we had the .com recession, the .com bust, and that drove us into recession in the early 2000s. But then we were riding high. Interest rates were around between 5 and 7% from the early 2000s. We were buying investment properties at 5 and 7%. Still worked really well, and you could see it wasn't until the 2008 crisis that's when we had the 2007, 2008 led us into a long, almost 2-year recession. You can see that bar is pretty thick. It was a pretty hard stop. And so the Fed drove the interest rates down to prop up the economy, continued to drive them down. You can see that chart all the way down into, was it 2.6%? I mean, that's what I got my house at, 2.7%. And then we had a small gray bar at the pandemic onset. It was, I think, 2 or 3 months of, quote, recession. Mm-hmm. And then they drove those interest rates down, the Fed rate down to zero, and then put trillions of dollars into the economy. Well, the result of that is that spike at the very end, and you're seeing the rates went from 3.1 in January of this year to 5.2, 5.1. Mm-hmm. To give you a perspective on what that does for payments, at a $3,500 mortgage payment, at 3.22% can afford an $802,000 property loan. At 5.11, the same $3,500 gets you $643.
Big difference.
It's about $160,000 less in buying power.
Yeah.
Just in the last 2 months.
Wow.
Okay. So people are saying, well, is that going to affect the market? What's going to do is you're going to buy a lesser price house, or you're going to pay more for your interest. You buy the interest rate down. There's all kinds of strategies we have on facing these higher interest rates. So same thing at a $500,000 level, which is kind of the medium price for us right now. 3.22 is 2167, and 5.11 is 2717. We're talking about $550 a month more for the same mortgage.
Wow.
That's a lot. That's and over the years, that's huge. But still, if you go look back at the chart, that our 5% interest rate is still historically low and continue. Still cheap money,
right?
Historically. As for our investors, it's changed the way we've done the investment performance, and everything's changed because rates right now in January 3.75 for investment property. They're but now 5.75. So for a $300,000 purchase, average, our usual loan amounts, about $225. They put 25% down. Payments $1,389 at 3.75 in January. At 5.75 at $1,750.
That's a lot of numbers.
It's about $360 a month more for the same mortgage now on that rental property. That basically has caused the positive cash flow that we were getting in most of our submarkets down to pretty much a break even. And so what about that break even? Is that okay to have a break even? Well, the bottom line is, yes, it's okay to have a break even because since we're in an inflationary cycle, the prices haven't dropped. The supply shortage hasn't dropped of the supplies getting here. We're still 5 million houses short in the United States from where we should be supply-wise. The builders can't catch up. The millennials are hitting the market. Being able to work from a distance created a whole new suburban sprawl movement, and so people are. The bottom line is we still don't have enough housing. Supply-demand means we're going to still have price increases. Now, not all over the nation, but here, certainly Central Texas, it has to happen. There's another dynamic that we didn't get into, but because those rates spike so fast, I've got a 2.75% interest rate on my primary residence. If I want to go buy another one, I'm going to have to sell that, get rid of that low interest rate loan, and get 5.25%. Mm-hmm. So a lot of people are going to stay put because they have this low interest rate locked in. So what's that do? Less sellers in the market. So mark my word, we're going to still continue to see hyper appreciation. Maybe not, certainly not at the 3 to 4% per month that we were having, but we're definitely going to have a higher prices in housing. But with all the turmoil, with the war, the saber rattling across the continents. Anything can happen, and anything can. Those gray bars. There's been not enough gray bars in the last 15 years, going back to the Great Recession. Mm-hmm. So there will be one probably within the next 12 to 24 months, maybe 36 at the outside. There will be a slowdown and potential recession. That's my prediction. All right. So with that being said, what do we do? If we look at the windfall, my property, that's my property. That's that property chart for the house near Avery. It's in Avery Ranch, and I still own it. The value went from 350, 360 back in 2020 or 2018. It doubled in value. And you can see it had a little bit of a hiccup earlier in the year. That was around September, October. That's after this huge hyperinflation, kind of the market kind of took a breath. But now it's just, Apple hasn't even opened up yet.
Right.
So there's like 4 houses in Avery Ranch, which is a subdivision of 4,400 homes. There's only 4 houses for sale.
It tells you a lot.
What's that, 1/10 of 1%? Okay. All right. Let's talk about what are you going to do with that windfall gain? Okay. You can sell and take your profit. We're going to talk about that on the income tax side of things. You can cash out. In other words, pull cash out. Now, granted, you'll be paying a higher interest rate now. Or you can just stay put and hold on to it or rent it out. Or you can do a 1031 tax deferred exchange, which is what our clients are doing. And we'll talk about how that affects and how those things, how you do that to save the most on taxes, to maximize your leverage. Okay. Property taxes are a big subject, especially with all our clients, especially the out-of-state clients that have properties here, because there is no cap on how fast the property values can go up as far as the county is concerned. So there is things set in place for our property tax people that are homesteads. My personal residence, for instance, went up, I think, $300,000 in 1 year. There's a 10% homestead cap. You file your homestead the year that you buy the house, and that'll give you a cap of 10%. So my house I bought it for $725,000. They appraised it $1 million. They can only raise it $72,000 in value. That's that 10% cap. On investment side, there is no cap. So it can go, let's say that same $700,000 house, if it was a rental and it went to $1 million, they can assess it straight to $1 million. So what do we do? That's a big jump. I just figured on a $400,000 jump in value, that translates to $10,000 a year in taxes.
Wow.
Extra taxes. Okay. So what do we do? I teach classes on how to protest your property taxes. There's an article, if you're getting this from an email that I'm sending out, I'm going to include an article from one of the news channels that talked about the different ways you can protest online and really just to get your protest in there. May 16th is the cutoff. It's normally May 15th, but if it lands, that lands on a Sunday, so it's the next business day. So May 16th is the cutoff to file your protest, and then there are great strategies on how to protest it either online, in person, or by phone. So, and I've got a class on that. It's a 40-minute video that I'd be glad to send out to anybody who wants to. You could Google it, property tax protest, Kenn Renner, or YouTube it, and you'll find it. So, said on that article, appraised values jump more than 50%. This is also pushing a lot of people who can't afford that jump. People are on fixed incomes. And so what do you do with that extra $500,000 or $400,000? That's a good question. So we're seeing a lot of people cashing out. And that's really why I'm doing this podcast, is that we have strategies to cash out, but don't pay Uncle Sam more than you need to. And then if you're going to cash out, where are you going to go? All right, we'll get to that in a second. All right, rental rate spike. So we were the number 2 rental increase city in the nation. Portland was number 1, 39% rental increase. Hey, if that's Donald Trump.
Oh, it's one of those. I have it on Do Not Disturb, but certain people can get through.
Oh yeah, Donald's coming to Austin.
Coming, yeah.
All right, so the rental rate spike. Okay, so that we had 38% rental price increase last year, number 2 in the nation. So those are landlords. Good time for you to look at making sure your rents are in line. Make sure your property manager is not cutting you short on having on getting those. So that's why one of my agents that has rental property goes, yeah, you see my assessment, it went up, prices went up. He goes, I guess my rent's going up just to cover it, right? Yeah. So we're seeing that rental rate spike. And the other thing was a cool, interesting stat was the CEO of Coldwell Banker, big real estate company. He came online that 52% of Americans don't even know what their house is worth. Wow. Half don't even know what it's worth. I'm surprised sometimes when I get these assessments. Yeah. I'm like, and I'm in it. So my point is, you might want to get with me. That's what I do all day long, is determine value for properties and try to maximize. If you're deciding you want to liquidate and move on or 1031 exchange, you'll need to know what the value of your properties are. So I'd be more than happy to run that for you. And we're seeing a lot of people. I had one guy, we got a home coming up in Northwest Hills. His house went up. He didn't even know. It went up over $1 million.
$1 million.
In 2 years. Yeah.
Wow.
And when I showed him the analysis, I just go, by the way, that $1 million because it's your primary residence, right? Yes. You've been there 2 out of the last 5 years. Yeah. I said, well, let's get the income tax strategies. Well, you won't pay any capital gain or any tax on the first $500,000 because you're married. He's like, really? Mm-hmm. And you think about $500,000, his tax bracket is $150,000 in taxes. Mm-hmm. That's wiped out. Now the additional $500 gain that he has, yeah, he'll pay some taxes on that. But the bottom line is that a lot of people don't know the rules on the 2 out of the last 5 year rule and things like that. So the question here is, how do we get out and move our assets if we decide to somewhere else? We need to defer the taxes or delete them all. I love that delete button on the taxes. So what I just said, the government's biggest giveaway is the 2 out of the last 5 year homestead exemption. That when you sell your house, you've been there 2 years, no taxes on the first $500,000. Second way is if it's a rental property, you can do a 1031 tax deferred exchange. We did a whole podcast on. You can go back through the archives, a whole podcast on 1031 tax deferred exchanges. So my lady that has a house very similar to mine, longtime client, she bought that house in 2005 in Avery Ranch. She paid $200,000 for it. We sold it for $675, multiple offers. And now she's doubling down. She's selling it, doing a 1031 tax deferred exchange, no tax liability. She bought a duplex in Temple, and she bought a brand new house in San Antonio. So between those, her income, if you notice on this chart, the rental income for this now $675,000 property is only $2,580. The rents don't cover. You're going negative every month. This doesn't make sense for an investor. But now, so she's diversifying into these other properties. So she's going to have 3 doors instead of 1, and her rents are going from the $2,500 she could get for this house to nearly $5,000 a month. So she's double down on the property. She kept the other one that she had in Avery Ranch. She bought that. She's holding on to that as equity build, but she's now getting a lot better cash flow. And of course, in these other areas, they are definitely going up in value. So that's what we do. We help people defer their taxes or delete them altogether through very legal means. That's what the IRS.
I hope so.
IRS, please, talk to your tax advisor. I'm not giving tax advice, but I definitely love strategizing with people, getting them to know what the value of their homes are. What can they do with that money? I have a lot of, I call them expats, expatriates. I'm in Austin now. I got all this equity. Don't really want to pay these higher property taxes. Everything's getting kind of crazy around here. Where do I go? We're seeing a lot of people move to New Braunfels, moving out to the hill country, still within access of Austin, but just going back into the time machine. You get 30 miles outside of Austin.
Right.
It feels like you're back in the 50s and 60s.
Which is great.
So anyways, that's my long show today, but we hadn't had a podcast in 2 months. So I really wanted to get back in here and give a lot of current information because a lot of things have changed in the last couple of months.
Good stuff. You want to wrap up with your daughter's song?
Yeah. This is called Sweet. Actually, if you see it on YouTube, she's got a great video on it. But yeah, she opened up for Bon Jovi at the Moody Center on the outdoor Hulu stage. So we're excited for her and hoping that we can keep Austin music alive.
Good seeing you, Ken.
Thank you, boss. See ya.
Sugar, what you don't understand. When life gives me lemons, I do what I can. Yeah. Hey, I'm addicted to it.